Hello, everyone. It's good to be able to see you in person, and I see so many familiar friends and faces online with us right now. It's going to be a great opportunity for us to spend some time together. That chat box is open. I can see already many of our friends are saying hello, which is awesome. Hey, everybody. It's good to see you. And Jenny Taylor, you're going to be spending some time with me today as we're discussing this amazing topic. So I'm looking forward to spending that time with you as well. How's it going today, Jenny?
It's going great. Thanks for putting this together, Ben. I'm just excited to be here and help host this important webinar that we're going to be discussing this topic today. I just wanted to let people know, if you haven't met me yet, I've been working with TRADEway for nearly 2 decades, and it's a great privilege to get to serve as an investment advisor representative for TRADEway, but specifically in the AMP division of TRADEway, where we help manage our clients' funds according to the TRADEway philosophy. So Ben, it's great again, like I said, to be here today with you and to get to work with you. Pretty much for about a decade now, I think we've been working together at TRADEway. But
Time
before you
flies.
were at TRADEway, you were in an entirely different field, weren't you? So why don't you tell us a little bit about yourself, for those of you that may not know Ben yet. Also, before you do that, everybody's doing this already, but just let us know where you're joining us from. That'd be great. We see people. Oh, said Debbie. I was like, you're in Sarasota, Debbie, but I guess not. I'm joining you all from. I use my Texas y'all for those of you in Texas, but I'm actually in Minnesota. So we got some nice summer weather here, and it's beautiful. But let us know where you're joining us from. We're happy to have you on here. And Ben, can you let us know a little bit more about you?
Jenny, I started doing this work with TradeWay in 2019 full time. But prior to that, I was working in a smaller company called Microsoft. You might have heard of that. And what I discovered as a person who knew nothing about trading is really didn't know anything about how to manage my portfolios. And what I really understood very well was the concept that David Mitchell teaches of I was trading my time for someone else's money. And that meant that I was trading an awful lot of my time for their money, and I didn't have the flexibility to do the things that I wanted to do as a dad, as a husband, as a follower of Christ involved in my church. There was so much that my job did not allow me to do. And in 2019, I transitioned out of the tech world. And I now do full time trading. I do full time investing, and I'm a huge part of trying to expose to people that were like me, that didn't know any better, some of the lessons that I got to learn. So I'm excited today, Jenny, to be able to describe to people just like you, the people who are here live on the webinar or those watching the recording. I'm excited to be able to share with you some of the things that is just not common knowledge. And I think about the Bible scripture, Jenny, that says, my people perish for lack of knowledge. Friends, there is opportunities out there for those of us who know, those of us who can be prepared. Well, we want to kind of be like the sons of Issachar, if you will, who knew what was happening and they knew what to do. We want to expose some of this information so that maybe some of the things we're talking about today won't let you off guard. So I'm looking forward to sharing that with you. And Jenny, I do want to make one more announcement before we get started here. The Q&A box is open. You know what? The chat box is awesome for being able to say hello. You know what the Q&A box is really good at? If you have a specific question, well, you can go ahead and type that into the Q&A box. And we have a few additional panelists that are on with us today that can help you with answering those questions. And we may answer your question live on air today as we're doing this recording. Most common question I get is, will this be recorded? Yes, it will be recorded, and the link will be made available. And let's see, Cassandra of our client engagement team, she is in the background. And we have Denny Foster, one of our IARs, on as well. So we have lots of people that can help answer your questions as we go. All right, well, where are we going today? What is our agenda going to look like? Well, what you can expect out of today is we're going to focus on the AMPT program. That's the Assisted Managed Portfolios by TradeWay. And we're going to talk about why we as a company leverage a broker called Interactive Brokers, IBKR. So anytime you hear us say IBKR, that means Interactive Brokers. We're going to spend some time today going over what we see happening that makes us very excited to leverage the strength of Interactive Brokers. There's many things that we see potentially forming in the economy, and we're going to highlight why we believe IBKR is one of the best opportunities we have as investors to help weather some potential future storms. Now, not only are they a strong broker, but we're going to talk about their tools and how we as traders get to leverage their tools. I'm excited to expose this information because many of you have never heard this before. Probably an active trader yourself, so you're probably going to want to geek out a little bit with this when you start seeing some of the things that we can do with the IBKR tools. And Jenny, you and I, we're going to be showing our friends a little bit more and talking through what that looks like. And then finally, after we're done kind of describing why and how we do what we do, we want to make sure those of you who want some help, well, we're going to give you a personal opportunity to have a meeting with one of us. Persons such as myself, Jenny Taylor, Denny Foster, others would be happy to have a personal appointment with you, answer your questions, and see if this could be a good fit for you. All right, so as we get started, part of why we use IBKR, well, unfortunately, there's some fairly difficult times potentially brewing for the United States economy. There are risks to the banking sector. The risks are unfortunately becoming all the more evident as we continue forward. And what's really a little alarming is the FDIC, that's the Federal Deposit Insurance Corporation. Their job is to be able to manage the banking sector, be able to help take care of issues as they're developing. And they do a quarterly stress test. Now, most of us don't ever pay attention to this because it's not that big of a deal. FDIC is what underscores our entire banking sector, and they just sort of keep things stable and going. Well, in order for them to keep things stable, they have to know the condition of all the banks that they're regulating. So the last FDIC quarterly review that was just released a few weeks ago had some rather alarming data. There are now 63 banks that the FDIC says are in danger of failing. 63. Now, this is a dramatic increase from the previous quarter, which is for us an alarming sign. When the number of banks that the FDIC, the regulatory agency that is monitoring and tracking and keeping track of their health, starts to inform us of a dramatic increase in the number of banks that they see are potentially in danger of failing, I think we should start paying attention. Now, Jenny, I'm going to ask it's on the slide here, but I want to ask a question. They didn't reveal the names. Why don't they reveal the names of these banks? Wouldn't we want to know the names of these banks?
Well, we would, right? But if we did know, what that would what that would really do is cause kind of like a self-fulfilling prophecy and create the run on the bank. Because what I guess a lot of people may not be aware is that a bank doesn't actually hold the cash reserves at their branch and at their bank for the amount of capital that their their people that have accounts there, their clients have. Like there may be $10 million in that little bank. This is a little bank example, but they might only have $1 million of cash available in that bank, right? Where if there's a run on the bank, everybody wants all of their funds, they literally do not have the cash to pay it out. And that's actually what happened in last March with the Silicon Valley Bank, which we're going to actually spend a little bit of time talking about. So Ben, what can we learn from that bank failure that happened last March? As in
Well,
March of 23, that is.
Jenny, you talked about it. It was the run on the bank that they are afraid of. Well, that's exactly what happened to Silicon Valley Bank. SVB is the abbreviation for that. Silicon Valley Bank, well, started with rumors, Jenny. Hey, there's a
Mm-hmm.
problem at SVB. They're not able to make their deposits. And they started to raise cash because people started to take their money out at an alarming rate out of SVB. And the reason why they were taking their money out, well, a lot of the depositors that they had in there had a lot more than the $250,000 covered by the FDIC insurance policy. So think about this. This is you. You have $1 million at SVB, and you know that it's only covered to $250,000. What are you gonna do with your money, Jenny? I'm just curious. Maybe our friends can help us. You got $1 million in the bank, it's covered to 250,000, and you start hearing rumors that the bank's in danger of failing. What are you gonna do?
You're gonna go try to get your money. Yeah.
So everybody starts asking for their money all at the same time from the bank. They don't have the money just sitting there ready to go.
Yeah.
They've got to go sell the assets that they have on the books and raise whatever
Mm-hmm.
capital that they can. Now, it's pretty interesting to recognize that it is not the only bank that has recently failed. And the part that's a little alarming as much as what the FDIC and the feds were able to overcome this challenge, with 63 banks on the list that are potentially in danger of failing, this next article that we found that we're referencing to me is quite alarming. All right, so I'm just going to read the headline, Jenny. We'll talk through it here in just a moment. But the historic yield curve, 656 days of a yield curve being inverted. Yield curve being inverted. What does that mean exactly? Well, it's not all that simplistic to describe because this isn't our world, but let me give you an analogy that might help. Many of you have a mortgage, right? Yeah, almost all of us have a home mortgage. Now, can you imagine right now if we were to go to get a mortgage 30-year? Right now, average mortgages, let's just say a 30-year mortgage is 8%. A 30-year mortgage is 8%. That's pretty normal, what we would kind of expect. Now, let's imagine that a shorter term mortgage, a 15-year mortgage, a 15-year mortgage is, well, you could do a 30-year mortgage at 8 and then a 15-year mortgage. A 15-year mortgage, they want you to do 10%. Hey, if you only want to use our money for 15 years, we're going to charge you 10% for that. But hey, use our money for 30 years, we'll give it to you for 8. Does that make any sense to you? Does that
It
make any
doesn't. It's
sense?
inverted.
No, it doesn't. And unfortunately, Jenny, I'm using that analogy because it helps us to see something's not right. How this comes into play is when you and I start looking at the bonds that these banks have on the
Hmm.
books. Many of them started their 10-year bonds 4 years ago when the bonds were trading for a 1% yield.
Yep.
1%. Okay, so the banks, which are taking these safe assets, these bonds, they're buying them hand over fist because that's the best they can do with their capital. And they're getting a 1% or less yield on these bonds. Okay, so does that explain why maybe your banks are paying you a pretty low interest rate? What do you think? How many of you out there have a bank account? Tell me in the chat if you would, your bank account. What interest rate is your bank account paying you on the funds you have deposited at your bank? I'm excited to see this one, Jenny. Less than
Yeah.
1%, Julie. Yeah, I would agree with that. Less than 1%. Less than one. All right. So, well, Sue, you got 4.3. I would say that's probably not a normal bank. That's probably a money market
It's
fund.
it's a high yield
Yeah.
savings probably.
High yield savings
But like
account.
your checking account, right? For people that keep and have like a couple tens of thousands of dollars in their checking account, a checking account is going to pay you pennies, just pennies. It's probably even less. Yeah, and it's like zero, zero. But yeah, there are high yield savings accounts that are available too. But your regular checking accounts are not paying. I mean, and just regular normal savings account are quite less than that.
So
But
that's what we're trying to call out here, Jenny, is the normal banking institutions that are a part of our economy, like the
mhm,
63 banks that are in danger of failing from the FDIC. Those that aren't like the money market funds offering the high yield savings, well,
yep,
they have loaned out their money and they have used your money to loan it out.
yep.
And if you start asking for your money back because you don't want to get just 1%, you want to go to a high yield savings account and you want to start getting closer to 5%. Well, what's going to happen to all the depositors at that bank? Jenny, what do you think? What's going to happen if people like us decide to start getting a higher yield savings account?
They're gonna need to take their funds and go somewhere else that's actually paying. So they will start removing their funds, and that's really what happened at S or Silicon Valley Bank. Is they came and they were needing to get funds. Well, that meant that bank had to sell their bond portfolio for a significant loss because, as Ben was saying before, if you bought the bond when it was a 1% bond, and now 4 years later, you can buy bonds that are 4 or 5%. Your 1% bond, nobody's going to pay you what it was worth 4 years ago. It's going to be significantly less for anybody to buy that from you. So they ended up having to take huge, huge losses in order to try to pay, give the money back to their depositors, and they couldn't do it. And that's why the FDIC had to step in.
So it's pretty crazy, Jenny, with this inverted yield curve. What happens is that when you and I think about it, it's only worth what someone's willing to pay for it. So if we bought that 1% bond, like what we just talked about, and right now on the open market, I can get a 5% bond. Well, what do you think I need to do to that 1% bond to be able to sell it? I have to offer it at what we call a huge discount. And that means
Yep.
it's not worth what it is that I paid for it. And that is the part that makes it so difficult on a traditional bank or banks that leverage bonds as a part of their safe way of being able to manage investors' portfolios. And when we all ask for our money back, well, it causes a run on the bank. So they raise the capital, they have to sell the assets at fire sale prices, and it causes the very failures that you and I are talking about. So that's really the key here. And Jenny, 356 days of an inverted yield curve. Is this significant for any particular reason, Jenny?
Yeah. Well, it's actually, this article was from April, and it was actually 656 days. So it's actually over 700 days now that these bond rates have been inverted. And this is actually the fourth time in history that it's been longer than 500 days. The other three times in history that this has happened was 1929. I think we all know what that year was.
Oh, I
What
mean
year was
the
that, Ben?
greatest depression of all history, 1929. Okay.
Okay. And then 1974. I believe that was during all the inflation issues.
Yeah, that was
Or,
Carter.
okay. And then 2008. I mean, I'm old enough to remember 2008 financial crisis, right? We're going to spend some time talking about that actually here in the next couple of slides. But our concern, okay, well, the other thing about that is each of those three previous times that the yield curve was inverted for 500 days or longer, and again, those are the only times it's ever done that, except for the one we're currently in, it was followed by a major stock market crash of 50% or more.
Ouch. Okay, so hold up. We're talking here, we're traders, we're investors, and here we see some things brewing within the economic conditions that many of us never even pay attention to, much less know about or why or how it works. And yet, Jenny, we're seeing that historically the past would tell us that when we see these conditions that a pretty strong decline could be on the horizon of the market, maybe we should think a little differently about how to get prepared for that. And here's a representation of what it is that we're talking about. Now, this is a chart that comes from the government themselves. They track these things. Let me tell you a little bit about what this chart is about. This chart gives you the time frames down below, right? So 1990s, 1995, each one of these gray bars represents a recession where the economy isn't growing. In fact, it's contracting and declining. So the time frame of the decline is these gray bars. And this chart shows the 10-year rate versus the 2-year rate. Normally, the 10-year rate is going to be higher than the 2-year. So here, the 10-year is higher than the 2-year, but it's declining, and eventually it goes negative where you're paying more for short-term rates than long-term, and it causes a recession. And then you come out of the recession, it uninverts as the economy corrects and interest rates start to change. And it happens again and again and again. And I'm just going to ask for a little bit of help here. Let me understand the pattern. When it comes down strongly, it typically leads to a gray bar. Let's look. It's come down strongly. We've been inverted for a long period of time. What would be the anticipated next period of time to appear in the not too distant future on this chart? You think we're just going to keep being white, everything's normal, the economy's growing, or would the pattern tell me to expect a recession? The pattern would tell me to expect a recession.
Now,
So,
we're not saying we know when that's going to be, right,
yeah,
Ben? We're
exactly.
not saying that, but we want people to be prepared and understand that, I know now we have a few more, I guess, safeguards, which is really the Fed and them lowering interest rates. But if we go into a recession and they're lowering interest rates, they can't bring us out of it kind of immediately, right? So, but that's in essence what they did in 2007, 2008, is they went to a near zero interest rate. And that was still a long recession that we were in during that time.
Excellent. All right. Well, Jenny, here is the thing that I'd like to do next is I'd love to get some engagement from our friends. And what I'd like to do is find out, how concerned are you? Right. So the FDIC reports I've shown you, you can go and look those up online. You can read them yourselves. They're very long reports. They're showing increasing fragility in the banking system. Our founder, David Mitchell, well, he's watching for what is the next catalyst. And not unlike 2008, could very easily be real estate, but this time probably the commercial real estate market. And we'll talk a little bit more about the 2008 decline in a moment, but that banking system decline, the systemic issues that face the entire economic system that caused the Great Recession and caused this huge downturn in 2008, over 50% decline in the market, well, there was a collapse happening. So I'm wondering, if these inverted yield curves for over 500 days have been so reliable in the past, my question to you, and if you can launch that poll, please, Jenny, are you ready for it?
Yep.
If another
I got it pulled
financial
up.
crisis develops, is your money protected? Why is that important, Jenny?
Well, we think it's really important because at TRADEway, we believe that buy and hold investing is dangerous. Okay. Because really, if your portfolio had mimicked the S&P 500 back in the 2000s, then you would not have grown your nest egg over a decade if it had mimicked, again, the S&P 500. We're going to spend some more time talking about that shortly. But what if we do see another major market correction of 50% or more? That's, what we're wanting to, ask right here is, are you protected from that? Would your advisor, if that advisor is a, more buy and hold, let it ride, it'll come back type of mentality, is it going to be protected? Or, do you have one that would actually go to cash and protect the capital? So that's what we want to know here, with this poll.
Excellent. Well, we have a few hundred people on today, so I can see as I'm looking at this poll, a majority of us, well, we've been in an environment in which, Jenny, we've kind of we just let it go, right? It's the normal
Mm-hmm.
mantra of the financial advisors, just buy and hold, it will always come back. Well, we're going to talk a little bit more about that as we get started. So I want to thank all of you who have participated in our poll question. An overwhelming majority of you are telling me that you really don't know and that you would like some help to figure it out. And by the end of today's session, we'll give you an opportunity where you can meet someone like me in person. We can have a meeting with you to discuss where you are, and then we can discuss what TRADEway may be able to assist you. So great participation there. Thank you, Jenny, for launching that poll.
Yeah. So, and thank you guys for answering that. And Ben, as we continue with our presentation, I wonder what can we learn from the past bear markets that we've you and I have traded through, but also just the past bear markets that are in the history of the stock market.
It's kind of our thesis, Jenny. So I'm glad you asked the question. What can we learn from those past bear markets? Well, one thing is that they happen. I mean, it's kind of obvious, right? They happen, but now let's go look at the conditions upon which they've happened, and let's look at maybe some data and some charts that can put some difficult concepts into pictures. And I love being able to talk about that, but let's look through these bear markets of the past. Let's put some focus on maybe let's start with the year 2008. It started in 2006. The yields became inverted, like what we described. You got paid better for short term than what you did longer. Things like mortgage rates started to skyrocket. Oh, wait a minute. That's not happened today, is it? Mortgage rates aren't skyrocketing, are they? Have you looked? It's the highest mortgages I've seen in a decade. Okay, so mortgage rates are skyrocketing, just like what happened in 2006. 2007, we started to see safe instruments like mortgage-backed securities. They became worth much less money than what they were worth on paper. Meaning if you went to sell them, couldn't get what you paid for it. And this was particularly true as I don't know if you remember 2008 where everybody was like walking away from their home because they owed more on their mortgage than what the home was worth. How many of you remember that? Raise your hand if you remember back when people were just like, I'm not paying it anymore. I'm just walking away from this property. Yeah, a lot of you remember that. And you know what that meant? The banks became owners of real estate. They became owners of real estate. Now, if a bank owns real estate, what do you think that bank is going to do? Sell
Try
the
to
real
sell
estate.
it. Yeah.
The real estate, because it's not like they have tenants that they can put on those properties. They want to sell it. So banks are selling these properties. Now, think about it. If the banks are selling properties at an alarming rate, and it's hard to get a loan because of the inverted yield curve and because of the elevated interest rates, what do you think is going to happen to all the prices of those properties? Hmm. Right. So supply and
That's what
demand kicks
happened.
in.
Hmm.
Lots of supply, not a lot of demand. Prices fall, and it exacerbated the problem. It made it worse. And number 4 on the bullet screen here is the Fed took unprecedented action. They actually opened up the checkbook and started buying every debt to create the liquidity required to be able to keep the economy afloat. And Warren Buffett, during this time, he's quoted in basically what he said. And let me just kind of give you the high level overview. There was a destruction of the United States economy. The Western economy was on the brink of the abyss. And if it wasn't for the fact that Ben Bernanke and the Secretary of Treasury working under George Bush at the time, if they had not done what they did in 2008, it would have destroyed the economy. Pretty interesting study.
Yeah.
The long and the short of it, Jenny, during that very difficult financial time caused by an inverted yield curve, caused by the economy and all the things that happens that most of us are completely unaware of, what we do know is the numbers for the decline of the market. 56% decline is what we saw in 2008. I tell you what, why don't we go look at that on a chart? Let's go look at not just the 2008, let's go look at some historical bear markets and let's break it out to where we can begin to see the impact of what it is that we're describing and more of a whole picture. All right, so bear markets through history, Jenny.
Yes,
Anything that we
and
want to focus on here?
yeah, we're going to go over what that chart means here in just a second. But we realize that our past does inform the future, right? We understand at the same time that everything is going to play out as it has previously played out. The different, like the 1929 stock market crash, the 74, 2000, 2007, 2008, they were all significant bear markets, but at the same time they had different catalysts. So markets are cyclical. There are bulls and there are bears. And at TRADEway, we try to take advantage of the signs that we know to look for that indicates to us where we are in the market cycle. So do we claim that we're going to know exactly where the top of the bull market is or the exact bottom of the bear market is? No, but there are signs that we can see based on charts. As well as then economic indicators that you can look at that can help you analyze and anticipate some of those moves. So David, I've worked with David for nearly 2 decades now, and David has been, taking part in and living through 50 years of the stock market, through 50 years of bear markets. And we believe and we've seen, that inverted yield curve is one of the most reliable recession indicators available. So if we do have a recession, and we could see those strong market declines again. And as we've talked about, it's already been inverted for over 700 days. So Ben, can you point out, this chart, what all these bars and these number means, and what are these R's next to some of the dates at the bottom? And why do those ones seem to be like more significant, bigger numbers than the other ones?
Absolutely. And it's really TRADEway's thesis in a nutshell, if you will, is this chart. So let's look. Past recessions are the R's. So let's just go look. I'm going to go point to some dates. So in 56, there was a recession, and the blue bar, the negative, that represents how much did the market decline. So 21% in the 50s. All right, another recession in the 60s, 36%. Another recession in the 70s, ooh, 48%. Ouch. 1980, 27 with a recession. March of 2000, 49% decrease. October 2007, 56%. That's what we've been talking about, right? That's the example, 56% decline. And then we had another recession in 2020 with a 33% decline. Those are significant impacts to the market, Jenny. When those historical numbers with really large declines to the market, recessions is what's causing them because nobody wants to buy stocks in a recessionary environment. Now, Jenny, this is pretty startling, but a 56% decline in the year 2008. That's what we've been talking about. Let's talk about the rest of the data on this chart because it's telling. The market went down for 17 months is what this blue bar says. The blue bar says 17 months of decline that went down 56%. Wow. At some point, Jenny, I think during 17 months of decline, maybe you might have gotten a clue. Just saying.
Maybe.
Saying, right? Now, the gold bar, this is the one that gets me. And we always hear buy and hold, it will come back. What they don't tell you is how long. So let's look at this one, Jenny. That gold bar says 49 months is what it took to come back. So I'm just going to do a little bit of math here in my head. Maybe you can help me out here. If I take 17 months of decline, I take 49 months to recover to get back to even. What is that, 66 months? How long is 66 months, Jenny?
That's 5.5 years.
Okay, so
That's a
five
lot.
and a half years to just get through the downturn and then come back to even.
Yep.
5.5 years, and that does not even account for inflation. Huh.
That's right.
I think I might want to avoid that, Jenny.
Yes. Yes.
So
Can
is
you hear
that
me? Okay.
Yep, I
Sorry,
can hear
my
you.
headphones were dying there, but okay.
So is that the end of the story? Is that really all this chart can tell us? Is, it just took almost 5 years to come back?
Well, what's actually really sad about this is so it came back and it kind of recovered back to even March and April of 2013. Okay. But if you go back to where it reached its peak in 2007, actually, that was the previous high before the 2000 market crash. So in 2000, in September of 2000, it had reached a high, the S&P 500 had, and we went into a bear market. This was the dot-com bubble, the dot-com bubble burst, okay? From September 2000 to October 2002, that was the bear market. And then from October 2002, it went back and recovered to even in October of 2007, but that's right when we went into another bear. So over the course of 13 years, your money, if it was, again, mimicking the S&P 500, which many do to a degree, your money didn't really gain anything in 13 years and actually lost because it wasn't, we weren't making any returns to keep up with inflation.
Wow. I'm sorry, you said 13 years?
Yeah.
I'm having a hard time comprehending that number. 13 years.
Yeah, if you look at a chart of the S&P 500, it went sideways for 13 years. And then late 2013, that's when it's gone on another significant kind of bull market run with some bears in that run. But again, that was what you would call kind of a long-term, I guess, just sideways bear market that it did have bulls and bears inside of it, because a definition of a bear market would be when it drops 20% from its recent high. So, or the high. So there were bulls and bears in it, but again, it went sideways for 13 years.
So a huge part of this was not only just a recession, it was the impact of the inverted yield curve. The impact that had to our economy took over a decade to play out. And I think that we can begin to see why we're asking the question. Why does this make sense, right? Most financial advisors, they will tell us as their clients, just buy and hold. It's always going to come back. And I have to be honest. I'm going to tell you, they're truthful. I mean, we saw in
Hmm.
the previous chart, it does come back. But you know what they're not quoting? How long? How long is it going to take to come back to even? And Jenny, I just want to use this chart to call out the last time that we were talking 2008. Let's just
Yep.
round down. It was a 56% decline. Let's round down to 50. What most of us don't understand is the amount of money you got to make back to get back to even is rather startling. With a
Yep.
50% decline, if I cut my portfolio in half, I now have to make 100% on my portfolio to get back to
Yes.
even.
Hmm.
100% return.
Yeah.
Okay, so it's going to get back to even. How long is that going to take? Well, that's pretty scary. Jenny, I wonder, I mean, is there anything that we might want to think about when it comes to that? I'm not as young as I used to be.
Well, yeah, and I mean, for those people that this happened to in 2000 and again in 2008, okay, if they were at retirement age, what did they have to do? They just had to keep working. If they took 40, 50% losses in their retirement plans, they had to keep working. So right now, if you're close to retiring or you're looking to retire, I mean, could you afford that kind of decline in your accounts? And that's why with the TRADEway philosophy, we say cash is a position. We're willing to sell the positions and put our money in cash, put ours and your money in cash and not hold through the major market corrections. This is why we created why David Mitchell, the owner and founder of TRADEway, created AMP.
And it's a pretty powerful consideration. And Jenny, what I will often ask people is this chart tells a story. You get 100% return on your money from 2008 to be able to get back to even. Can you
Mm-hmm.
imagine if you didn't lose 50% of your portfolio during that recession, during that crash, during that 17 months of decline? And I love to ask this question. How different could your portfolio look if you didn't ride the bears all the way to the bottom?
Yep.
If instead of losing 50% and then having to make 100% to get back to even, what if you didn't lose 50%? And when everybody else around us is just struggling and trying to get back to even, we preserved a lot of our capital through these fairly knowable cycles of the market. And our cost basis coming out of those recessions was not as impacted, or even potentially we made a little bit of money on the way down because we thought like a trader and we had the capability of leveraging things that can increase in value during a decline. How different could your portfolio look? All right. So, Jenny, if you and I were retiring in 2008, that was a pretty bad deal. And I think you said it before. That's why David created the program, right?
Yes, it is. He wants to be able to help people with their retirement funds and their assets to not see that capital just depreciate. And the idea is if you think over your generation, the next generation, like the generations of your family, if you're
Yes.
avoiding these bear market crashes. Now, of course, you're going to have small drawdowns. That's going to happen with any sort of investments, but you don't need to see a 30, 40, 50% drawdown. It's not necessary to have happen in your accounts. So that's why
So,
he wanted to create this.
so we're leveraging a very strong company, Interactive Brokers. We're leveraging traders' mindsets, and the AMPT program, Assisted Managed Portfolios by TRADEway. That's what AMPT stands for, by the way. And I often joke, yes, we worked really hard to try to make that acronym fit, but we're assisting you in managing your portfolio with the mindset of a trader. And Jenny, you and I, we're two of the primary individuals that help people. We have other investment advisors as well, but I'm a little concerned. We're moving on. How many days did you say the yield curve's been inverted now?
I wish I had done the math and had the actual number, but it's over 700. I do think it's one of the longest, if not the longest time that it's been inverted.
Okay, I mean that is one of those things that tells me that it's really a good opportunity for us to consider not just being with a buy and hold advisor, getting with someone
Mm-hmm.
that thinks more like a trader who isn't afraid to maybe do things a little differently than what the financial services sector would say. And
Yep.
this is a little difficult to describe, but I need to ask you a question. if you're investing with someone like, I don't know, I'm just going to pick a name. Somebody, let's see, I've got somebody out there in the chat window. Somebody has a 401k at Fidelity. Perfect. Let me just use this as an example. If you have funds at Fidelity, chances are you are also invested in the Fidelity mutual funds, the Fidelity this fund, the Fidelity this fund. Fidelity makes money off those mutual funds regardless of what happens. That's not the way that we do things at TRADEway. We do not make money off of your account. And in fact, we're incentivized to help you to protect and to grow your account by the account structures that we have. Fidelity likes people to buy and hold because Fidelity makes money regardless of what happens. All right. It's a little bit of a dirty hidden secret here, but the financial services world, there's some nepotism going on there. Fidelity makes money whether you do or not. So just want to call that out. It's worth considering. All right. So why we use interactive brokers is because they don't have funds like Fidelity does. They are simply just a broker, and they make money off of the transactions that happen inside the account. And the things that happen inside the account, well, there are times in which it's a good idea, at least in our opinion, as traders, you don't always want to be invested. So when we're not invested, Interactive Brokers is paying 4.83. That's the current rate as of July of 2024. 4.83 on qualified accounts when we're in cash. When we're in cash, meaning we're not real comfortable with what this market's doing, let's like let the train go by to see if we should get back on the tracks. Let's go to cash and let's wait. 4.83 is what we can make for just being in cash. That's stellar. Now, the other part about interactive brokers and what we want to call out and why they are our chosen partner, they are not exposed to the long bond risk, that inverted yield curve that we described to you. That's not how they manage their money. That inverted yield curve will not affect them like it does most banks. Why? Well, it's because of what they do. Instead of those long bonds, they leverage short-term treasuries. Short-term treasuries, those that hold their value, things that hold the opportunity for them to be sold even at or near what they paid for them, if not a small profit, and they can hold it through the duration without an awful lot of risk. Right? IBKR is a huge part of why we can do what we do. Virginia, this next point, I want to ask you, do other brokers, do they pay anywhere near that 4.83%?
If you have an account at a broker where you're the one managing the account, you're self-directing your IRA, that kind of thing. Those brokers, they don't. It's going to be probably less than 1% or less. I've seen some as small as 0.1%. So you're not getting to be able to move them into the higher rate money market funds at those brokers. And another great thing about interactive brokers is that they have what's called a cash sweep program, which leverages up to 10 different banks, allowing for up to $2.75 million of FDIC coverage. So instead of having to split your accounts into your money into different accounts to have that 250,000 coverage, Interactive Brokers does offer this enhanced cash sweep program, again, to qualified accounts.
Okay, so that FDIC insurance that we talk about, that 250, it's the same organization that's monitoring all the banks. So they have they have to control this, right? Because they can only cover us up to $250,000. Well, Interactive Brokers is really smart in that they're leveraging those 10 different banking partners in the background. That's a pretty powerful way to do it. I love that part of IB, and I don't know a lot of other companies that do that. So not only do they have these great technology enablements, not only do they help us with being able to do the things that we do in the background, but they have enhanced FDIC insurance. They pay us some of the best rates in the business. And they're one of the most strongly, how do I put this? In 2008, there was a lot of companies, a lot of businesses, a lot of individuals that took their money out of the bank and put it into IBKR because they knew how IBKR managed their funds. And as one of the strongest institutions that continually passes the stress tests, there was a lot of funds that flowed into IBKR during the last crisis. We kind of think it's going to be the same way during the next crisis. So we're prepared. We're using the company that a lot of people fled to during the 2008 crisis before the crisis hits. Pretty powerful stuff. Hey, Jenny, this is a good time for me to just pause for a second. Are there any questions that we need to cover specifically?
Well, I think now would be, let's go into the IBKR tools and then let's cover any questions. And
Excellent.
and one of the things that, let me just point this out. Cassandra went behind the scenes and figured out the math for me here. So, Cassandra has figured out that it's been 740 days actually since
Um,
the bond yield inverted. So thank you, Cassandra, for doing that. I just wanted to point that out here. And Cassandra and
700,
Denny are actually answering quite a few of the questions behind the scenes right now too, though.
740 days. Wow, that's the largest in history. The last time we got anywhere close was the financial crisis and the Great Depression.
Oh,
Wow,
749.
Th- those are those are worth noting. Past does often inform the future. I want to
Mm-hmm.
be prepared for that. I want to be prepared for that. So IBKR, the interactive brokers, the tool sets, and something else I really want to call out because there's some real power here that, unless you were involved in something like an AMPT program, you would never even know that interactive brokers existed because they don't
Mm-hmm.
they don't cater to investing people like you and me, like the retail clients.
The
They're
retail,
they're
yep.
going after the TRADEways of the world. They're going after those that
The
manage money for
advisory
other
firms.
people. Yeah.
Mm-hmm.
So
Yep.
so TRADEway,
Well,
why do we use IBKR? Well, amped advisors, people like me, people like Jenny, we can invest more like traders. They're tool sets. They help us to manage the funds, some click button simplicity. And we, as your advisors, well, in and out of trades is what we can do. And we use discretionary trade authority on your account. You see everything we do. You can log into your own portal. You see all the trades that we do. It's always going to be an account in your name. Pretty powerful way to do it.
yep. And on that
So,
subject, we're not the custodians, we're not the broker dealer, right? We would just have the discretionary trade authority for your accounts. You grant that to us when you become our client, okay, as well as when you submit the application at Interactive Brokers to create the account. One of the other, like we've already touched this, but if we do see um, strong correction or a reason that we think the market is turning over and we can move to cash, we do utilize that the cash sweep, the money market fund, which is right now paying that 4.83%, versus maybe about 1% at some other brokers, which again is higher. It's higher than those, but it's also higher than many just regular, savings or checking accounts as well. And Interactive Brokers does have their site has more details and different comparisons. And just so you guys are also aware, that rate there, that 4.83% rate, it changes based on what the Fed's fund rate is set to, right? So if they would increase rates, well, this will go higher. As they decrease rates, this also goes higher or goes lower, sorry. And the reason for that is, if as they're increasing interest rates, well, the more other things tend to be more attractive than
mhm.
the stock market, right? That's what caused the market decline, was them raising interest rates. So people started putting more funds into bonds and at the higher interest rates, as well as then these types of money market funds that you can like at Interactive Brokers. Now, as they start lowering rates, then it's not as it doesn't look as good, right? Oh, a 2% interest where you could maybe go invest in the market. That's why it tends to be when the interest rates get cut, the market does better. Okay. So that's just I just wanted to throw that tidbit out there to you guys.
Yeah, pretty
But
awesome, Jenny. And so think through this, Jenny. We're giving information that most of our friends don't know. And that's the role that we have as investment advisors with you. We're here to try to help answer your questions and guide you through these rather complex topics. And using interactive brokers is one of it's how we advise people to more help to protect their funds. Okay, so let's talk about this next point, Jenny. TradeWay
mm-hmm.
manages the IBKR accounts by risk tolerance and the cycles of the market. Think about it. We're not just buying and holding. We have different portfolio types. We have bearish portfolios, we have bullish portfolios, we have squirrely portfolios. And it literally takes a few clicks of the mouse for you and I to be able to change these portfolios in action. Now,
Mhm.
Jenny, you and I, we're two of the primary people in the background that are actually doing this at IBKR. Let me ask you a leading question. How long does it take for you to be able to get people into a cash position if we choose to go to cash? How long does it take for that to happen?
If we go to cash, I mean, it'll take maybe 15, 30 seconds. It's
Wow.
very quick for hundreds or thousands of accounts. It doesn't really matter how many accounts there are. We can we can do multiple at one time with the Trader Workstation, which is Interactive Brokers trading platform. So it
And
allows us to do all that, to do what we need to do to be able to have discretionary trade authority over our clients' accounts rather than taking custody and putting your money in like a fund.
yeah, it's
So
pretty powerful because then you get to maintain your account. You see everything that goes on in the account. And yet at the same time, we have the ability to trade as if it were our account. I can say go buy 5% of Microsoft and it'll buy 5% in John's account and Mary's account and Sue's account. It does it as a part of the tool sets because you've granted us discretionary trade authority. It's pretty powerful the way that that happens. Now, the last thing I want to talk about here, Ginny, on this slide is how about the fees? Is there any advantages to TradeWay being the person or the company doing the trades for our friends?
yeah, well, we're actually going to be the ones that are paying their what are called professional market data fees of at least $125 a month. And so we're covering that. You wouldn't have to pay that if you would be considered a professional, or if maybe you have a business account that would have professional market data fees. The other thing is because of the size of the positions that we put on, the number of shares we're buying and selling, we're able to do these in batch transactions, which reduce the fees. So the fees are then distributed across all the accounts based on the number of shares that were purchased per account. But it just means that it's very, very low commissions, low fees whenever we need to make any changes to the portfolios.
And it's a great call out. This last point that I want to make, Jenny, is there's many of you who have LLCs or entities that you have started for trading accounts, and you've discovered that you have to pay professional market data fees um, over $100 a month. Well, we are paying our own professional market data fees. So what if you allowed TradeWay and the AMPT program to manage your business account? You wouldn't have to pay those fees. And that would be a really powerful way for maybe you to have your cake and eat it too. Let TradeWay manage and trade your business account, and then you don't have to pay those professional market data fees. A lot of people do that. It's a pretty powerful way. Okay, so Jenny, let's talk about the two programs that we would suggest that leveraging IBKR, leveraging TradeWay, what do we offer as far as portfolios? Well, we have a long-term program that we call AIM. If you've been to step one, you know that David has always suggested take 80% of your money and preserve it. Don't let those bear markets take 50% of your portfolio. Well, that's what the AIM program is designed to do. Questions in the chat box. This is where we would leverage sector-based ETFs. The longer term portfolio, Rhonda, we're using sector-based ETFs as a way for us to be able to create the diversified, safer portfolios that are a part of the AIM program. Our 80% money, it pretty exclusively leverages ETFs. Now, I take that back. There's a few individual instruments, things like some of the gold sectors, there are some individual instruments, but almost all the things that we do in the long-term program are based off ETFs. So that's the long-term program. Now, 80-20 is what we suggest at step one. 80% keep it safe, sector-based investing, diversification, that's AIM. What about trading? Well, what if TradeWay could trade for you? Well, that is the UP account, the Ultra Portfolio account. And this is where we do leverage individual stocks. So accounts that are under 10,000 will leverage individual stocks. Jenny, Jared, myself, what we do is we get in and out of individual stock instruments. We hold one another accountable. We keep our trade plans. We document them. If one of us is on vacation, the others can help, and our team is managing those active positions. So Rhonda, the other side is I'm also using individual stocks, and I'm doing that as a part of the Ultra portfolio. So Rhonda, the question is both. We leverage ETFs long term, we leverage individual stocks short term. And then you're also asking another great question there, Rhonda. I see it right there. Do you use calls or puts? If your account values are above $25,000 and you're in the ultra portfolio, then our rule sets and how we manage the funds and how we help to protect the funds, you have enough in your account to allow us to consider participating in calls and puts. So clear answer. If you have over 25,000 and you're up, you can get calls and puts and spreads in your ultra portfolio. If you're under 25,000 in your ultra portfolio, you get individual stock positions. So I hope that makes it more clear.
Hey, Ben,
Okay.
before we go to the next slide, can you take a moment and just, we've got a lot of people asking, hey, I've got a 401k, it's at my current employer, or hey, I've got an old 401k or an abandoned, or can you just let us know what kind of accounts that we can help manage for clients?
Perfect question. So let me answer the 401k question first. It's the most common one. Whether it's a 401k, a 403b, it's a 40 whatever account, they all have pretty similar rules. You're very restricted in what you can invest in. So what you need to do is ask your benefits administrator of those 401 programs, how much can I roll over to a self-directed IRA? That's the question that you ask. How much can I roll over to a self-directed IRA? And then our team can help you to do that. We can help you to roll it over into an IRA at Interactive Brokers, and then our team has the discretionary trade authority to manage those funds. So that's the question you have to ask. Call 1-800 My Benefits Administrator. How much can I roll over to a self-directed IRA? Once they give you that number, let us know what that number is and we can help you with it. Solo 401ks, what we would want to do is, Kelly, we'd want to have a conversation on that because you would have to recharacterize at least a portion of those funds. You could keep your self-directed 401k fund for purposes of continuing your contributions, but then you would have the ability to roll over and recharacterize those funds as an IRA. That's the flow that we would suggest there.
Okay.
Okay.
I have another question because we got a lot of people wondering this. Are we saying that we think if they're doing their personal trading, they're trading for themselves, should they switch to IBKR?
Ooh, that's a tougher question. I'm going to tell you that IBKR's tools are not simplistic, in my opinion, and I'm a
Their
techie.
trading
Right?
platform is what you mean, right? By
Yeah,
that,
correct.
by tools.
So the
Yeah.
trader workstation that comes from Interactive Brokers, the tool trader workstation, Jenny, that you and I use to manage hundreds and hundreds and hundreds of accounts, it's not simple compared to like charts, for example. So,
Mm-hmm.
I mean, for a brand new trader, I think charts is the way to go. And unfortunately, charts does not link up with Interactive Brokers. Um, but if you want our help, we can trade those funds on your behalf. And what I tell people all the time is, when's the last time you talked to a financial advisor who was trying to work their way out of a job? I hope you get that at TRADEway. I want you doing this on your own. But until you're ready, why not get our help with your funds protected? When you're ready, you can always roll this over to an IRA at any of the other providers that integrates, and you can manage your own funds when you're ready in the future. A lot of people do that. Then I want to use
Mm-hmm.
AMPT to help protect my funds today. I want to learn as I'm trading,
Yeah.
but man, I'm not ready to go trade my retirement account. Good. Please don't. Let us
Mm-hmm.
help you to protect. And when you're ready, then you can take over. I'm trying to work myself out of a job.
Yep. Yes. All right. Well, I think we've got most of them answered. And here's the thing, a lot of these questions are they're personalized, it's specific. That's why we really need to have a meeting with you to discuss your specific goals, objectives, your specific account types that you have, to see which ones you have and which ones we would maybe help you manage. Oh, you got the slide up there, Ben.
Well, you
So,
transitioned to it. I thought it was a great idea. So,
man, okay. All
all right.
right,
So,
we do
ready to
have,
get started with AMPT? Well, Jenny, if you could, would you go ahead and launch the poll question? So,
I will
the
in a
poll,
second. I've got to find the window that I had open here. Okay, there we
so
go.
Jenny, while you're doing that, let me talk with our friends a moment. So really we're at the stage of where we've given them a lot of information. There's more that you can read. You can go out to our website. www.tradeway.com/amped is where you can sign up for an appointment if you'd like to, if you're watching the recording. Jenny, I should have put this acronym out there, AMPT-story. So tradeway.com, AMPT-story. So Rhonda, you're asking about the percentages and the cost of how Tradeway gets paid. It's all based on how much you bring over. So if you go out to amped-story, you can look at exactly what our fees are. There's nothing hidden. It's not like we're trying to hide it. But I will tell you that our fees are based on how much money we're helping you to manage. It's called AUM, assets under management. Now, Rhonda and friends that are asking, what I'm going to tell you is that Tradeway, we make money when your accounts do better. So we're incentivized to help to protect your accounts and to grow your accounts. Because in order for us to be able to make more money as a company, well, those account balances need to get protected and grown. Unlike the IRS, which has a graduated tax scale that charges you a higher percentage with the more money that you make, we charge you less. So the higher your account balance is with us, the smaller and smaller and smaller and smaller the percentage fee that you pay us gets. So as your accounts grow over time, we decrease your rates. When you and your family members come together, so let's say a husband and wife come in together, we're going to add your accounts together to determine both your fees. So if together you and your husband are bringing in accounts where all of them equal $500,000, we're going to charge you the $500,000 rate. I don't know a lot of advisors that do it that way. We do. We want to think about this as a family. So very unique program, very different way for us to have those conversations. You want to know more? Just time with us. I mean, seriously, just book a time with us. You can do that right now. If you're working with one of us, the poll question will help. So are you already working with one of our advisors? Let us know who you're working with. Are you not working with one of our advisors? Well, we'd love to get you connected with somebody who can help answer your questions. So Jenny, as they're clicking on this poll, what's going to happen after this webinar for people who are clicking on this poll?
Yes, you guys are going to receive an email, eventually even a text message with our scheduling link. We have calendar scheduling links so that you can book a meeting at a time that works for you. And you'll be able to click on that day and time and enter your name and information. And then after you've submitted that, you're going to get a calendar invite with a Zoom link. And that's when you'll be able to get on a call with one of us, one of the investment advisors for AMPT. But yeah, you should be receiving an email, maybe even today, but probably tomorrow, inviting you to book a meeting with us. Ben, do you want to take a minute to tell them about, say, the best people that help in our whole department keep everything running the best? We call them our client engagement managers, and we actually have the lead CEM on here today, Cassandra. Can you tell them what they would be helping them with?
It's actually another very unique part of our program is a lot of these financial services company and starting an accounts and those things, it's pretty complicated. So we have a whole group of people that we've developed because we know that in this world it can be complex and we want to make what's complex easy for you as our clients. So the client engagement managers, CEM, that's how we abbreviate it. Their job is to make this easy for you. They'll schedule an appointment with them, they'll do a session with you, and they will walk you through the fairly complex process of creating an account. And with their help, it's not complex anymore. They'll help you to know the answers to the questions and show when interactive brokers is being tricky on their language. Doesn't take very long to do when you have an expert guiding you through. So that's what those people do. They're experts at helping you to start the account. And then they help you with the process of getting the funding moved over. As you can imagine, your old advisors are probably not too keen on seeing the money leave. Well, this entire team of people, their job is to help you to get that part done without an awful lot of stress for you or your family. So client engagement team, it's a pretty important part of our services. And there is no fee for you to be able to join our program. The only fee you pay us is the asset under management fee, and we'll describe that to you in depth. We charge less than most active money managers to be able to help you with your funds. Now, we are more expensive than an average buy and hold investment advisor. If all they're doing is calling you once in a while, asking you if you'd like to do something to your portfolio and they're really not making shifts, they're not going to charge you a lot of money. We're making active decisions. We're going to charge you a little more than a buy and hold advisor would. All right. Let's see here. Jenny, I think the only other thing that I can think of here, are there more questions, Jenny, that we had that came up?
Well, we do have Anne asking, what should she do or everybody do to prepare for the meeting? with an
Oh,
IAR,
no,
which is an
that's a
investment advisory rep. But I don't even think we've had that question on any of these that we've done before. So thank you for asking that. That's a great question.
I thought I'm just like, wow, we should probably add that to the slides. In order to be prepared for that meeting, you know what would be most helpful is for us to have just sort of a snapshot of what it is that you're thinking about. Hey, I've got this Fidelity 401k account at my employer, and I called my benefits administrator, and they say that this is how much I can roll over. That would be awesome. I have this IRA at Schwab, or fill in the blank. If you can sort of have a statement of your accounts, where they are, what type of an account they are, that can really help us accelerate and help answer your questions when it comes time to have that personal meeting with a financial advisor. We'll be asking those questions anyway. So if you have the answers to those questions in advance, it really makes it much easier for us to have a collaborative conversation about how we may be able to help and what we would do to advise you with those investments. Well, that's a pretty big part of the meeting. So having that information in advance helps accelerate everyone. Great question. We need to add that question. Okay.
All right.
Any other questions there, Jenny? I've seen several come through. It looks like
Well,
Cassandra and Denny are doing a great job in the
yeah,
background.
we've got people making fun of your puns and that you haven't made a whole lot yet today. So
Oh, well, I'm really
that
excited.
saved that
I
saved
tell you
some
what,
eye
I'll make my
rolls
favorite
this
pun.
week.
I'm excited. In fact, I love the name of this program because I'm all amped up about what I get to do to help people. How about that one?
There we go. There we go. Sorry, Cassandra. Shouldn't have said anything about it. But what I wanted to kind of do to maybe kind of bring us to the conclusion is also just, there are going to be people that watch this as a recording. So of course you don't have access to the polls. So if you are interested in meeting with one of us, please just go to that www.tradeway.com/amped there. And there's a short form that you can fill out. And then what will happen is one of us will be in touch with you via an email, potentially just a phone call, maybe a text to schedule that appointment with you.
Awesome. Now, Jenny, as we close, the last benefit of IBKR I want to highlight is you have your own login when you join our program. You can log in, you can see everything that we do. They have great tools and reporting. You can create links to your own bank accounts to be able to transfer funds around. You have control. And that's what I love about what it is that we do differently than most financial advisors. Friends, we would love to help you. Time to get prepared for a storm is not during the storm. 749 days tells me that we could be on the cusp of an economic hurricane. I don't wait for the hurricane to hit to get prepared. Somebody who just went through a power outage in Houston and I was out for over 9 days. I don't wait to get prepared for that for me and my family when the hurricane is on my doorstep. I get prepared ahead of time. If you'd like our help, the economic hurricane looks to be forming. Can we help you with it? We'd love to get you in a place where you've got better protection, a company like IBKR to back you up with all of the things that we've described in today's webinar, and a grouping of investment advisors like us at TradeWay to help you get through those difficult times that we're pretty sure are coming. So thanks for being on today, Jenny. I appreciate your time and help and all of our friends in the background. This was an awesome webinar, and I look forward to helping you soon. And thank you so much for your time today. Bye, everyone.
Bye. Thank you, everyone.